Well, good afternoon, everyone, and thank you so much for taking the time to join us today. My name is Nick Deppenthaler, and I am a lead planner here at the Center for Financial Planning, as well as the director of our firm's financial planning department. I'm really excited to cover a topic that I'm extremely passionate about, and that's retirement income planning. Over the last, I'd say 2 or 3 years, I found that in many cases, I tend to work with folks who are within 5 years of retirement or are currently in retirement and kind of either approaching that stage or currently in that stage of that transition of working and putting money into accounts and accumulating to kind of that shifted mindset of now having to take money out of their accounts, which can be a little bit stressful. So a common question that I hear is, how do I actually get paid when I'm no longer working? In many cases, that's one of the biggest concerns that either people who are currently retired, or I should say recently retired, or those who are quickly approaching retirement. That's a common question and a stress that many people have. So that's why I thought it would be great to carve out some time today to cover this important topic. At a high level, we're going to cover the process that we would take when advising clients on the various aspects of their retirement income strategy, and even look at a case study of how we might actually work together with someone to ultimately structure their own tax-efficient retirement paycheck. Just a few quick housekeeping items before we dive in. Because we do want to be respectful of everyone's time today, we do ask that if you have questions, please jot them down. Feel free to reach out to me after the webinar. I'm going to have my email address up at the very end. Feel free to shoot me a note or give me a call afterwards. Happy to talk through any questions that you might have. We will also be sending out a recording of today's presentation within the next few days. So with that, we will dive in, and I thought it would be very interesting just to take a quick peek at the history of a 30-year Treasury bill through the that's guaranteed by the U.S. government. So as you can see, as I'm sure many folks on the call today, or anyone who's viewing the presentation, you remember back in the 80s when you thought you were getting a good deal on your mortgage when you had 13%. That's just incredible to me when you take a look at how dramatically different rates are, interest rates, how they were in the past compared to now. So back in the day, you essentially could purchase a 30-year Treasury note backed by the U.S. government, even if we look at, in the mid-90s, and that would pay, roughly 6%. It's a pretty easy way to create retirement income in a guaranteed fashion. Well, as we can see today, that just simply doesn't exist. 30-year Treasury notes and bills are under 4%, and we need to explore other ways and to ultimately create that retirement income paycheck for clients. So the heyday of just simply buying a bond that's insured by the U.S. government and living off the interest, those days are kind of over for the foreseeable future. So what are some key areas of how we will actually create that retirement paycheck for you? What are the various sources that will ultimately comprise that quote unquote paycheck that you will receive when you're retired? So we kind of look at these different areas in two main factors. So we have the fixed sources, and then we have your variable sources. So the fixed income sources would include items such as your Social Security, your pension, annuity payments, or even potentially part-time employment income. The variable, on the other hand, in most cases, that's simply your investment assets, your portfolio, how things are invested in your IRA, your 401k, your brokerage account, etc. So how do we put the variable, which would be the investment assets, and I say variable because that's going to fluctuate with what the market's doing, obviously, and then the fixed income sources, as the name implies, that's really not going to adjust in most cases. We can rely on those. We know what they're going to be each and every month in most cases, and then we say, okay, well, what is your spending goal, and how do we put these two together to recreate that paycheck for you and allow you to spend what you want to spend in retirement in the most tax efficient way possible? So how do we combine these two, strategize to ultimately get you money so that way you can do the fun things that you want to do in retirement and not have to worry about the dollars and cents? I also thought it would be very important today to discuss income tax brackets. As most people I'm sure are well aware of, there was a significant tax law change at the end of the year that's now impacting tax rates in 2018 and going forward. So here we've outlined what those tax brackets look like. And so we've listed here married filing jointly and single filers. So these tax brackets are extremely important when we're sitting down with a client and saying, okay, how much would you like to spend in retirement, and running projections, and number one, seeing if that's realistic. That's the first step. Number two is saying, okay, this is a realistic number. What do we want to spend? How do we combine these fixed income sources such as your pension or Social Security, annuity income, etc., the items that we reviewed on the previous slide? And how do we combine that with your portfolio income to be as tax efficient as possible? So everyone is going to have their own unique spending goal. That's going to be different for every single client in every single situation. But what does stay constant is the tax ramifications of the different accounts and different income sources that you have access to. So when we combine those different sources, we really have to do a deep dive in saying, okay, when we add those up, what bracket are you going to be in? Is there a way to structure your income to maybe maximize lower income tax brackets, or take funds from different accounts to allow you to avoid pushing into a higher tax bracket that could potentially impact things like your Medicare premiums, or even if you're on if you're receiving healthcare subsidies because you retired prior to age 65 and don't have access to employer paid healthcare expenses anymore. So we're really thinking through all these different items to say, okay, what bracket do we need to keep you in, and what is the strategy, so that way we're being as tax efficient as humanly possible. So here we're looking at marginal tax rates. One other item that I want to point out, capital gains rates. So for anyone who is in the 10 or 12% bracket, either married or single, that capital gain rate on the federal side is going to be 0. So if you purchase a security in a taxable account, and when I say that, I'm not referring to an IRA or a 401k or a Roth IRA. This is an after-tax brokerage account. You purchase a security for, say, $5 a share. You sell it for $7 a share a couple years later. There's a $2 per share gain. If you're in that 10 or 12% tax bracket, you actually don't pay any tax on the sale of that security. If you have income under $250,000 if you're married, or $200,000 if you're single, it's 15%. And I won't go into the weeds on the income levels above that for the sake of time, because in most cases, people are typically subject to either that 0% tax rate or 15% rate. So to piggyback off the previous slide, I thought it would be interesting to take a look at the various types of retirement income sources and retirement accounts that we see in most cases for clients, and really look at it from a visual standpoint, just to outline how different the tax ramifications can be depending on what type of account or what type of income source that we're looking at for clients. And all of this really does play into how do we ultimately pull money out of all these different accounts, or how do we structure that paycheck to be as tax efficient as humanly possible. You're going to hear me use that phrase or say, you know, create that tax efficient paycheck several times. I'm going to beat that to death, but that's really a key component to developing your retirement income strategy. So if we look at the very first line item, your traditional IRA or 401k, most people are familiar with this. You know, the money that you're putting into these types of accounts, you're getting a tax break. So ultimately, when you go to pull the money out, you do pay tax on what you put in, and ultimately what the earnings look like as well. In some cases, if you make contributions to a non-deductible IRA, there might be a small component that when you go to take money out, it is tax-free. But, you know, for the most part, in almost all cases, the bulk, if not all of the dollars that you're pulling out of a traditional or pre-tax IRA or 401k is going to be subject to ordinary income rates. Ordinary income rates, think the rates that we just looked at on the previous slide. Now on the flip side, a Roth IRA or Roth 401k, when you go to take money out of those types of accounts, it's going to be completely tax-free. Now that sounds wonderful, right? I mean, who doesn't want to be able to pull money out of a retirement or an investment account and not pay a dime in tax? Well, the only reason why you're able to do that is because you did not receive a tax deduction when you put the money into the account. So I get that question all the time from clients, and it really just, the question is, I should outline it, is, which account should I put money into? Should I put money into a Roth, or should I put money into a pre-tax or traditional IRA or 401k? And it really just boils down to what tax bracket are you in right now compared to what you're going to be in the future. So in many cases, that tax deduction that one would receive if you deposited money into a traditional IRA or 401k is very, very meaningful. If you think of the last maybe 5 years or so of your working career, you're probably making the most money that you've ever made in your entire life. In many, many cases, that's kind of where we hit our peak in earnings. So receiving that tax deduction is very meaningful. Now, everyone's situation is a little bit different, but in many cases, we can even fill up the traditional 401k bucket, and then depending on what your income is for the year and if cash flow allows for it, we can also contribute to the Roth IRA and get you some dollars put into a tax-free bucket that we can ultimately draw from in the future. Now, the third and final investment account that I'd like to look at is just your simple brokerage after-tax investment account that is not an IRA, is not a 401k. The best way I like to describe it is, think of a checking or savings account that just so happens to be invested in stocks, bonds, mutual funds, ETFs, things of that nature. So the money that has gone in to that account that's invested, you already pay tax on it, but it's not tax deferred like you might see in a Roth IRA or traditional IRA. So with that type of account, you're going to be subject to ordinary income tax rates on things like dividends or interest. You might pay some capital gains if you sell a particular security in the account that has gone up in value. And then, of course, you might even have some tax-free income coming out of that account, maybe some municipal bonds or even just cash that you're holding in there that you already pay tax on. Now, when you go to draw it out, you don't pay tax once again. So now if we shift gears a little bit, we've covered the different actual investment or retirement accounts and how those different vehicles could change or have different aspects from a tax standpoint. Let's look at the actual fixed income sources to see how those could change depending on the different aspects and what tax rates could look like for those particular income sources. So for a pension, in almost every case, every dollar that's coming to you as a pension is going to be subject to ordinary income tax. Now, I have seen in some cases where there's a very small component that is tax-free because maybe you put some money into it at some point, but in almost all cases, the bulk, if not all of your pension is going to be subject to ordinary income. Social Security, in many cases, clients are going to pay tax on their benefits. The most that you could be taxed on your Social Security benefit is 85%. And when I say 85%, I'm not saying that the tax rate on the benefit is 85%. I'm saying that 85% of your total benefit would be included in your taxable income for the year. So to give a very simple example, let's say you had a $10,000 a year Social Security benefit, and depending on your other income, the most that you could be subject to having that Social Security included in your taxable income would be $8,500, which of course is 85% of that $10,000 a year benefit. An annuity, the final income stream that we're going to look at, is going to have, just like Social Security, a component that is taxed at ordinary income and tax-free. So let's think of a situation maybe 15 or 20 years ago. You put in a lump sum of $100,000. Well, now that annuity has grown to $150,000. And you've come to a point in your life where you say, you know what, I want to actually annuitize that account or that contract and start receiving a monthly benefit. Well, because part of that annuity value is based on two components: what you actually put into it with after-tax dollars and what the account has seen some growth in. So there's a component when you ultimately go to annuitize the account and start receiving income. Part of that money that's coming to you each month is essentially what you deposited, and some of it is comprised of the earnings. So part of that monthly payment is going to have some ordinary income, tax ramifications, and part of it is going to be completely tax-free. Portfolio construction is a huge component of creating a retirement income strategy for a client. So now we're kind of shifting gears. We're moving away from the tax treatment of the different accounts and the different aspects of the fixed income sources that you might have come in each and every month. And we're just going to focus in on how do we actually construct a portfolio when you're in the distribution mode of taking money out of your account. So one of the largest components that we really spend a lot of time on with clients is understanding what is the spending goal. Okay, if you want to spend X amount each and every month and you have X amount coming in from things like Social Security and pension, where does the gap fall in? What do we need to replace with the portfolio? And then from there saying, okay, well, we want at least 6 to 12 months of that gap or that portfolio need to be sitting in cash or money market instruments where, really regardless of what the market is doing, you're going to have that cash on hand and be able to supplement your spending needs regardless if there's volatility in the market like we've seen as of late. The bond or fixed income component we kind of view as the medium-term bucket, so to speak. So we want that part of your portfolio to cover about 1 to 5 years of expenses. So on a similar, or I should say in a similar vein, comparing to the cash component of your portfolio, the bonds, yes, there will be some volatility, especially if we do see some interest rate movements like we have as of late. There will be some volatility there, but not nearly as much as we would see in the stock or equity component of your portfolio. I've heard a lot of concern, and it is a real concern, and we're taking strides to mitigate interest rate risk in our bond portfolios for clients. However, the worst year that we ever saw in the bond market, in the U.S. bond aggregate, kind of the bond equivalent of the S&P 500 was down about 8%. That was the worst year of all time. So, that's certainly down 8% in what should be a conservative portion of your portfolio. Certainly is never a great thing, but hopefully that kind of puts things in perspective when we take a look to see, okay, well, what are the worst years in the stock market? Down 40 or 50% potentially, depending on what year you're looking at. So nowhere near the type of volatility that we would see with the third and final component, which would be the stock or equity side of the portfolio that's really there to drive growth and look beyond 5+ years and allow clients to see growth in their account even though they're taking money out. We need to have enough, as I mentioned, in bonds and cash to help stocks recover in a down market. I use this analogy often with clients, and I say, if you cut your finger, for example, and you didn't put a Band-Aid on it, you didn't put any antibacterial ointment or peroxide on it, you pick your what you want to use to make it heal. If you didn't do that, you just let it go, either it wouldn't heal, period, or more than likely you might even get a scar from it. It's kind of the same conversation or analogy that we would see with your portfolio. When we see volatility in the market like we have as of late, or even if we take a look back to 2007, 2008, the clients who had significant assets in bonds and cash, and they were able to pull from those instruments and really just let the stocks be, let them recover from the wound that the Great Recession caused, so to speak. Those are the clients that really had the most success. Where you can really end up shooting yourself in the foot is when you're taking and drawing a significant amount of money from the equity side of your portfolio in a down market. This is one of my favorite charts, and it kind of piggybacks off of the conversation I was just describing about letting stocks recover. We're going to see volatility in the market. This is a really great chart that I just absolutely love. It's produced by JP Morgan each and every year, and it takes a look to see, okay, what has the volatility been like over the last 38 years. This chart is showing and saying, okay, over the course of almost 4 decades, on average, each and every year, we have seen almost a 14% decline throughout the year. So almost every single year, on average, the market at some point has gone down almost 14%. 29 out of those 38 years, despite that 14% decline, the market has ended positive. So that just goes to show you why we need funds in cash, why we need funds in bonds. The market is going to be volatile. We are going to see fluctuations, and we need different buckets of money to help get us through those periods of time. So I thought it would be great to kind of go over a case study with everyone today on the call, just to walk everyone through how we might actually approach working with a client and really digging into their situation and saying, okay, from the very beginning, what are the steps that we need to take to make sure that what you're spending is appropriate, number one, and if that number is appropriate and if it's realistic, how do we combine your fixed income sources, the various accounts and assets that you've accumulated? How the heck do we combine all of that to allow you to actually get paid in retirement, go on vacation, spend what you want to spend, and really not have to worry about the dollars and cents and be as tax efficient as humanly possible? So we're going to take a look at a married couple, both age 65. They have a before tax spending goal of about $120,000 in retirement. They've accumulated a nest egg of $1 million in their investment portfolio. And between the fixed income sources that they have coming in, adds up to about $78,000. So as I mentioned previously, there's a gap there, right? So we need to kind of fill that gap in some way, and that's that $42,000 that we're looking at is the difference between that $78,000 in fixed income that they have compared to the $120,000, which is their spending goal. So that $4,200 a year, or if we look at it on a monthly basis, $3,500, has to come from their portfolio. Their current investment allocation, roughly 60% stock, 40% bond in various diversified mutual funds and ETFs. So if we take a look at that, what does that look like? How much do we have in each bucket? So keeping the math simple, on a $1 million portfolio, if 60% is invested in stocks, obviously $600,000 in that bucket, about close to $380,000 in the bond bucket, and then just over $20,000 in the cash bucket. So you might be wondering, okay, well, where did you dial in on that cash bucket number, the $21,000? The $21,000 is coming from 6 months multiplied by 3,500. So that gets us to the $21,000 figure. As I mentioned, we want to have at least 6 months of cash, in most cases, on hand to be able to facilitate monthly withdrawals out of your accounts. So that way, no matter really what's going on in the market, we don't have to draw from the stock component or even part of the bonds if there is some valuation fluctuations where that cash is staying the same. It's not fluctuating, the balance isn't going back and forth. We can get you your paycheck and we don't have to worry about fluctuations in the market. So how do we actually make that happen? Okay, how do we actually pull the dollars to be as tax efficient as humanly possible? How do we recreate that $3,500 a month spending need depending on the different types of accounts that the client has? So we mentioned that the client has a $1 million portfolio. All right, so about 600 grand is invested in a traditional or pre-tax IRA. $300,000 in an after-tax joint investment account, and about $100,000 in a Roth IRA. So how do we pull money from these three different areas to ultimately get that client the $3,500 that they need to live on to satisfy that $120,000 a year spending need or spending goal that they have? So if we can take roughly $1,700 a month out of the client's IRA, that is going to keep the client within the 12% tax bracket. If we take $1,800 per month out of the joint investment account, if we think back, we really don't have to pay much tax. There's no ordinary income tax due on pulling money out of this type of account. Now, granted, you might see a little bit of capital gains or a little bit of tax on interest and dividends, but this full $1,700 a month is going to be fully taxable. The $1,800, you're going to see very little tax due with that sort of distribution. Now, we wouldn't want to take anything out of the Roth, and we'll touch on that in a few minutes as to why. So how did we get to these figures? How did we get to $1,700 a month out of the IRA? How did we get to $1,800 a month out of the joint investment account? If we take the $1,700 per month and we multiply that by 12, and then we combine that with the $78,000 of fixed income that's going to be taxable to the client, and then we back out, okay, what is the client going to receive from a standard deduction of about $24,000? That $1,700 a month figure is going to keep them within that 12% marginal tax bracket. In many cases, I have seen where clients say, well, I don't want to pay any tax. Why would I take money out of the IRA? Why wouldn't I just take everything out of this joint investment account where really I don't pay any tax at all? So in that case, you would be taking $3,500 a month essentially out of this particular account. I'm not a fan of doing that. I'm a fan of balancing the different tax ramifications, and just like we would want to diversify the investments in your account, we want to take a look at diversifying the tax treatment and the distribution planning that comes into play when we're recreating that retirement income paycheck for you. What can happen in many cases is if we do take the $3,500 per month out of this joint investment account, we're quickly going to draw down this balance. Okay, so what's going to happen over that time frame is this IRA is going to continue to grow. This joint investment account is going to continue to decline, and now we're going to have a very large asset that's fully taxable. And if we think at age 70 and a half, when we have to start taking out required minimum distributions from your account, this account, this traditional IRA that RMDs are subject to, is going to be extremely large, and that distribution could potentially push you into a higher bracket. I've seen this happen before where there was not a balancing act in any sort of way when the distribution planning for clients was put into place from different advisors or different companies, and they quickly ran through an account that they really didn't pay much tax on, and now they have this really big IRA. And if they would have just taken some distributions out of the accounts, they still remain in the low bracket. As I mentioned, that 12% marginal bracket is where they would fall. It ultimately pushed them into a higher tax bracket because that RMD was so large because they had let the IRA grow for 10 years. And in that case, because they have to take out that fixed amount each year, their AGI or their adjusted gross income rose to a place where their Medicare premiums jumped dramatically. So we're really taking a not just a year-to-year look at your situation, more of a 10 to 15 year look down the road to say, okay, what is your tax situation now compared to what it's going to be in the future? Can we structure your payments in a way where you're still paying a low rate now? You might not be paying zero, you're paying a low rate, but long term, you're going to be in a better position than just taking everything from this joint investment account and not paying really any tax whatsoever. In many cases, the Roth IRA is a great tool to use in the future. Because the Roth does offer tax-free growth, in many cases, we want to essentially let that account be and let it grow. And in some cases, we might even make that account a little bit more aggressive because it does offer tax-free growth. The Roth IRA is a great tool to use in situations where, let's say, a really large expense comes up, all right, and you need to take money from your IRA in your joint investment account, but it's such a large amount that, we might actually be pushed into a higher bracket because of the amount of money that we need to take out from the IRA. That could be a perfect situation to say, okay, well, we have this Roth IRA component. Could we potentially explore taking money out of that account to have a client avoid pushing into a higher bracket? Because if we remember, the Roth IRA distributions are not taxable whatsoever. So at that point, we would be combining all three different accounts and getting you the money to ultimately satisfy either that $3,500 a month spending goal, or, as I mentioned, a large spending need, and helping to avoid you pushing into a much higher bracket because we have this Roth component that is not going to be taxable at all if we take money out. It's a great tool to kind of have in your back pocket for when those potential situations occur. And as I mentioned, we really take a close look at how that account is allocated, because in many cases, it's an account that we don't plan on touching for many years. And because it does offer that tax-free growth, we want to be a little bit more aggressive and have a little bit more stock in that particular account to take advantage of the tax-free growth aspect. So to reiterate, kind of the why behind structuring the client's retirement paycheck this way, we're able to keep the client within the 12% marginal bracket. So that $1,700 a month in conjunction with the $78,000, if we remember, between the $78,000 that we have coming in with Social Security and pension that's taxable, if we combine that with the $1,700 a month from the IRA, that still keeps the client within the 12% marginal bracket, assuming they take the standard deduction. As I mentioned earlier, it also helps diversify the tax treatment of portfolio withdrawals. You think of anything in life, typically when we go from one extreme to the other, usually sometimes bad things can happen. So usually a balancing act of some extent of taking money out of each different bucket, or at least a few, typically works out in a client's best interest long term, because we're diversifying the tax treatment. You have different buckets to pull from for different situations that could come up later in life. And also, as we discussed, potentially reducing RMDs, or the required minimum distributions, at 70.5. So these clients are 65. If we don't take this $1,700 a month out of this account and we take everything out of this joint investment account, this traditional IRA, assuming we have decent market returns, is going to continue to grow. And the RMD that you will have to take out of the account, in theory, is going to be substantially higher compared to doing it this way and kind of having that balancing act approach of taking a little bit now, still keeping the client in a low tax bracket, but doing it in a way where we don't just take everything out of an account that you really don't have much tax liability, and then getting really hit hard from a tax standpoint 5 years down the line. So in conclusion, as I wrap up, I thought I would end with one of my favorite investment quotes, very popular, from Warren Buffett. Investing is simple, but not easy. I kind of view accumulation when you're working and you're saving and you're putting money into a 401k. It's simple, but it's not easy. Being consistent in saving requires a tremendous amount of discipline. But if you select the right investment allocation that's right for you, given your own personal risk tolerance, and you save a fair amount of your income, accumulating really doesn't have to be all that difficult. On the flip side, when it comes time to retire, or you're approaching retirement, and you're now at a point in your life where you have to make some of the largest financial decisions of your life, whether it be when to take Social Security or which pension option you want to take given the 25 different options that your employer has offered. Or which accounts do you pull money from? Do you take that money? How much do you take out of the IRA? Do you take any out of the Roth? Do you take any out of the joint or individual investment account? Those are the decisions that really require a high level of professional guidance, in my opinion. And in many cases, this is a stage in life where we see many people who may have done the investing on their own come to us and say, you know what, I've done pretty well on my own, but I'm at a point in my life at this stage where I need some guidance on the distribution planning when I'm in retirement. So if you have any additional questions or you really want to dig into things, feel free to reach out to me. My email is on the screen, nick.deffenthaler@centerfinplan.com. We have a tremendous amount of resources on our website, various blogs, webinars that you can view. We also have a monthly newsletter where we discuss different technical financial planning topics. And as I mentioned earlier, if you have any questions at all from today's webinar, feel free to reach out to me, and I'm happy to talk through those questions with you. So thank you so much for joining us today, and I hope everyone has a wonderful week.